we are going to look at the most interesting concepts in trading financial markets. These concepts are called the Wyckoff concepts. Wyckoff concepts is a combination of two concepts. These are the SMC concepts and the AMD concepts. So Wyckoff is a combination of SMC plus AMD. Have you heard about the SMC concepts? The SMC concepts, this is the smart money concepts. When we talk about the AMD, we are talking about the accumulation. This is the manipulation and the distribution concepts. Okay, good. So to understand the Wyckoff concepts better, we look at four main parts. All right. So the first parts that we are going to look, we are going to understand and look at the three laws designed by Wyckoff. Okay. So we are going first to look at the three laws of the Wyckoff concepts. Secondly, we are going to study a very interesting concept called the composite man. The composite man. This is equivalent to the evil man in the market. We will come to see why it is called the evil man. Okay. The third concept, we are going to study about the Wyckoff price cycle. This is the movement of the price in the financial markets. Okay. The fourth concept we are going to study is the Wyckoff volume spread analysis. Okay. The Wyckoff volume spread analysis. So in basic terms, the Wyckoff concept is a combination of these four parts. One is the three laws that define the Wyckoff concepts. Second is the composite man. Third is the Wyckoff price cycle. And fourth is the Wyckoff volume spread analysis. If you get a good understanding of these four concepts, you are so good to tackle the SMC concepts and the AMD concepts. So we are going first to study the three laws of Wyckoff. And the first law is the law of supply and demand. Okay. The first law here, it is the law of supply and demand. I'm very sure in your trading endeavors, you've heard about supply and demand. Okay? What does this law state? This law states that when demand is greater than supply, the price will rise. All right? So when demand is greater than supply, what happens? The price will rise. This is a basic principle when trading the financial markets. When the demand is greater than the supply, the price will rise, meaning we will have some bullish momentum. Okay? What happens when the inverse happens? When the supply is now greater than the demand, the price will fall. Good. So this is just a summary of the law of supply and demand, as we will be using it in trading the financial markets. All right. So fast forward, we are going to look at the second law. The second law is the law of cause and effects. Okay. So our second law is the law of cause and effects. Our second law is the law of cause and effects. Remember our first law, we said it is the law of supply and demand. This law usually is affected by the smart money concepts. The second law, the law of cause and effects, usually affects the AMD concepts, the accumulation, manipulation, and distribution. So, according to this law, it says that for a certain event to happen, there must be a cause. And after the cause has happened, there must be an effect. All right? Remember, we've said these two words, accumulation and distribution. So in this case, an accumulation can be a cause of an event happening. After accumulation has happened in the financial markets, we expect to get an uptrend or some bullish momentum. Okay? When distribution happens, it is a cause. And what happens after that cause is that we get a downtrend, okay, or some bearish momentum, okay. So this law, the law of cause and effect, states that for a period of accumulation, this is where the smart money concepts are accumulating some bullish positions. So this defines a cause. All right. After a period of accumulation, we will have an effect. So a period of accumulation leads to an uptrend. All right. It leads to an uptrend. So in this case, an uptrend is the effects. And hence, the law of cause, the law of accumulation, and the law of effect, which leads to an effect, which is the uptrend. What about the downtrend? The law suggests that for a period of distribution, which is the cause, this will lead to a downtrend. This will lead to a downtrend. In this case, the downtrend is what? The effects. Okay? So majorly, the second law is a law that is based on the AMD concepts, the accumulation, manipulation, and distribution. For a period of accumulation, we get a cause, okay, which leads to an uptrend, which is the effects. And for a period of distribution, which the distribution is the cause leading to a downtrend, the downtrend is the effects. Okay? So remember, for price to move, there must be accumulation of positions and distribution of the same positions. Okay? So what brings about some little difference is the manipulation that gets in. Okay? We are going to study the manipulation when we will be studying the composites man. Okay? So if this is clear, we will go to the third law. Any question on the first and the second law? I know that the first law is quite clear. We are quite conversant with this, but the second law is a bit challenging, but we are going to look at it deeper. So the third law is the law of efforts versus results. Okay, this is where we will look at the Wyckoff volume spread analysis. Okay, so I will wrap this and look at the third law. That is the law of efforts versus results. So the third law is the law of efforts versus results. Okay, good. So this law states that price changes are a result of an effort, okay, which is represented by the trading volume. Okay, so here the price changes are as a result of an effort. This same effort is characterized by trading volume. So for a price to move higher and higher, we must have bullish efforts and bullish trading volume so that the price may be pushed up and up. All right? So according to the same law, if the price action is in harmony with this trading volume, there's a good chance that the trend will continue. All right? But remember, if the effort, which is the trading volume, is not in harmony with the price action, that is where you get the manipulation. You may find yourself in a very good trading setup, a breakout trading setup, but when you look at the trading volume, is not in harmony with the price action. Just know that that is manipulation. But if the price action is in harmony with the volume, there is a good chance that the trend will continue and the price will move according to the trend. Okay, but if the volume and the price will diverge, there is a chance that the trend is likely to stop or change direction. That is what we called manipulation. Okay, the law of effort versus result. So for trade confirmation, it is always good for you to look at the trading volume. You see good trading volume and there is a price action confirmation of a breakout, that is good, and it will show you that the price will continue to trend in that direction that you had placed your trade. Okay, so if this is clear, we are now going to look at the second part of the four parts that we said, the composite man. Please pay close attention to this. You will hear many traders talk of stop hunting and manipulation in the markets. So Wyckoff tried to explain this phenomenon in this simple term, and he called it the composite man. The composite man. Okay? The composite man is an equivalent of this M. What does M stand for? Manipulation. So the composite man is defined as the manipulator. His action are the results that you hear traders in the market said that my stop has just been hit and the price has reversed and is moving to the direction of my take profits. Okay, so the composite man is an imaginary identity controlling the markets. That is according to Wyckoff, that it is just an imaginary identity controlling the market. Okay, so the first point is that the composite man acts on his own best interest to ensure that he can buy low at the best price and sell high at the best price. Okay? So the composite man will sit behind the scenes and manipulate price to his own advantage. His goal is to move the market to your own disadvantage, but to his own advantage. That is why he will try to accumulate some positions into buying positions. When you are seeing the buying positions, the trend has already moved. You get into a bad price, he reverses the price, takes you out, and then moves to your desired positions, hits the TP. Okay? So the composite man, the manipulator, is constantly seeking to maximize his own profits at your own expense. Mostly, the composite man are the big fish in the markets. These are hedge funds, bank, okay, and big traders. So the composite man's behavior is the opposite of the retail traders, the small traders like you and even me. Okay? So it is said that the composite man, his actions are very identifiable to the eye that is quite familiar with his actions, that if you see those actions, you know what he's going to do. So if you study the SMC concepts well and the AMD concepts well, you will know the actions of the manipulator and you are going to avoid them. Okay? So according to Wyckoff, the evil man uses a somewhat predictable strategy from which us as traders we can learn. Okay? So we are going to learn what this composite man does so that we may avoid falling for his traps. All right? So the composite man or the manipulator, they plan and execute their deceptions well in advance. So I said, if you master the SMC concepts, you are able to see those deceptions early in advance. Okay? So basically, the composite man is there to fool you to buying positions that he has already accumulated. Let's say that the price was consolidating here. You will find that the composite man will start buying positions here bit by bit. Okay? Once it breaks out, he deceives you to buying positions around here and here and here. What the composite man will do, he will bring the price down, takes away your stop losses, and then the price will come to this demand area that he had already created, bounces off that and goes all the way to your take profit. So he's literally using your positions as liquidity for him to take profits here at your take profits. So the composite man will tempt you to sell at the worst possible time. Okay? But the good news is that the composite man leaves a very clear evidence to his strategies for those who can understand him. So that is why I'm continually saying that you must have to apply the SMC concepts and the AMD concepts to beat this composite man. Okay? Good. So after learning about the composite man, we are going to look at the Wyckoff price cycle. The Wyckoff price cycle is a combination of 4 phases. The first phase is the accumulation phase. The second phase is the markup phase. The third phase is the distribution phase. And the fourth phase is the markdown or the downtrend phase. Okay, so we are going to wrap this and look at now the Wyckoff price cycle. Okay, the Wyckoff price cycle. The Wyckoff price cycle. This one, I've said that it is made up of 4 phases. What are these phases? One is the accumulation phase. We said this is the cause and an effect. Number 2 is the mark up phase. Number 3 is the distribution phase. And number 4, it is the mark down phase. Remember the second law, the law of cause and effects. We said that the accumulation is the cause. After the cause, what is the effect? The effect is markup. What is markup? The markup is uptrend. So the uptrend is the effect. Good. In the case that the traders will feel that the price is overpriced, okay, distribution starts to happen, which is the cause. All right. So here, people are taking profits from their buying positions. And what happens? People are starting to sell. Accumulation leads to buys. Markdown, which is an equivalent of downtrend, is what? Is an effect of distribution. All right. So this is according to the second law that we had studied. Okay. So distribution and markdown is a combination of the first law. The first law, the law of supply and demand. So this is where supply comes in. All right. Accumulation and markup phase is a combination of demand. All right. So this is accumulation of demand. So these are the 2 laws that constitute the Wyckoff concepts. Okay. The third law that we said is the law of effort versus results. We said for an effort to be legit, for a result to be legit, the effort, which is the trading volume, must be in harmony with the price action for us to get a good chance that the trend will continue in our own direction. Okay. So just to illustrate with a small illustration, we will have something we call accumulation here. This is the first phase. This is a phase that a small percentage of traders will feel like the price is fair enough. It is a good bargain for them to enter. All right. And they start pushing the positions higher and higher and higher, bit by bit. So this is where you get the composite man when he wants to buy. Okay. We said that he leaves a clear evidence to his strategy for those who do what? Who understands him. So this is the accumulation phase. Okay. So this is the accumulation phase. After the price has accumulated enough, we will go to the second phase, which is called the markup phase. Okay. So this is called the mark up phase, which is an uptrend. All right. So most of the dump money, you'll get them getting here. All right. When it reaches here, the composite man, those who apply the SMC concept, will feel like the price is overvalued, overpriced, and hence it will trigger something we call the distribution. They will start taking profits. Okay, so this is the distribution phase. The place where the composite man, those guys applying the SMC concepts and the AMD concepts are taking profits. This is a cause. The cause of their action will lead to an effect. The effects will be a downtrend. Okay, so this one is a mark down, which is a down trend. Okay, so if you can look clearly at this, you will see four phases. The first phase is the accumulation phase. The second phase is the markup phase. The third phase is the distribution phase. And the fourth phase is the markdown phase, resulting to a downtrend. Okay, so in the accumulation phase, here the composite man accumulates assets before most investors. Okay, but look here, the accumulation phase is done gradually, bit by bit, to avoid the price from changing gradually and making you, a retail trader, from noticing that we are now accumulating and we are in an uptrend. Okay, good. But once there is this breakout, if it is accompanied by good trading volume, we can enter our trades here and enter into this uptrend, looking for our taking profits here at the distribution phase. All right, so during this phase, the bulls, the buyers, are slowly gaining power. As a result, they push price higher and higher and higher. Okay, so we are going to look at the second phase, the third phase, and the fourth phase. To correctly identify the accumulation phase, we said that the price action on the chart, you will notice to be flat. The price is in a range. Okay, so a period of accumulation, you will notice that the price will be flat. It will be in a range. Okay, good. So ideally, this is what illustrates price in the accumulation phase, that the price is generally flat and in a range. But you will notice, due to the actions of the composite man, those people who apply the SMC concept, you will start noticing some higher lows, higher lows, higher lows, and higher lows, and higher lows. All right, so this is a period of a course. We said this is accumulation, and there is a course. What follows here is an effect. The effect is characterized by something we draw like this. It is characterized by an uptrend, a markup phase. Okay, so let me ask you, what leads to this markup phase after this accumulation of these positions that you can see here? Okay, so we can see that there is an emerging trend here. A higher low, a higher low, a higher low, and a higher low. So this attracts more traders. All right, so here this one will attract more traders, hence more volume. Okay, so what this does is that it causes demand. So demand will increase. So this becomes a demand zone. This will cause demand. This becomes a demand zone. What this does is that if there is more volume, according to the Wyckoff volume spread analysis, there is an expected breakout here. Okay, there is an expected breakout. This breakout will lead to an effect. The effects will be markup phase, which is an uptrend. So consequently, we will find more higher lows and higher lows and higher highs and higher lows and higher, as more traders are getting into this trade, and the price will continue going higher and higher and higher. Why? Because there is more demand than supply. Okay, so as the market is moving up and up, other traders are encouraged to buy and continue coming in and in. The demand is greater than the supply. Okay, so there is continue breaking out to the tops, and the price is going higher and higher. But just as the price is going higher and higher, the price will reach here. And most traders will realize that the price is overvalued. Okay? The price will be expensive, so that nobody is now willing to buy and go up and up. What this does is that it creates a period of distribution. Okay? So a period of distribution is a period that is the price action again is flat. Okay, the price action here is flat. Why? No more traders are willing to buy into these positions at this price. They think that the price is expensive. Remember, the composite man is buying low and selling high. So the composite man will apply the SMC concept and will try to now distribute his positions that he had already bought here in this distribution phase, and we will see what he will cause. Okay, so the price characteristic here is that the price will begin to range. All right, but consequently, we're reaching here, we'll start to see positions like this and this and this. Okay, so here the price, we will see that the price is unable to create higher highs on the charts. Okay, the price is unable to break higher and higher and higher. So the composite man will be tempted to start now pushing the price down. Okay, the supply now will become greater than the demand. All right, and a downtrend will be established. Remember, here we said that there was an establishment of a demand zone. Up here now there will be a supply zone. What happens in the supply zone? Yes, there will be more traders who will come selling from these positions, but we will see some bearish positions. Okay, good. So as more traders are thinking that this price is more expensive here, more traders, more volume, and definitely we will see a breakout out of this range. All right, good. Remember that the supply zone and the distribution here is just a cause. The effects will be a downtrend. The downtrend will happen because the composite man will be doing what? He will be taking profits. How does he take profit? By distributing the positions that he had already bought here, and he is looking for buyers to take those positions. Then he's using your positions as liquidity to take his profits, and hence this will cause the price to fall down and down and down. All right, so this is generally the Wyckoff price cycle. It is made up of 4 price cycles, which is the accumulation, the markup or the uptrend phase, the distribution phase, and the downtrend phase. The downtrend phase. This happens over the daily chart and even to the 1 hour and the 1 minute chart. This is continually happening each and every time. You will see that the price is constantly in phases of accumulation, distribution, which causes uptrend and downtrend. We are next going to look at, this is where the manipulation will happen. Okay, manipulation happens here in the accumulation phase and even in the distribution phase. Okay, so as I had already said earlier, the 4th part of the Wyckoff concept is the Wyckoff volume spread analysis. How is volume important when trading? Remember, we are expecting a breakout here, but this breakout will be affected, the effects by this course, if the volume is enough to facilitate this breakout. But if the volume is not there and we are seeing a breakout, that is a false breakout. Okay, so the Wyckoff volume spread analysis provides confirmation of the progressing events during the Wyckoff price cycle. So if we are in the accumulation phase, we will see that we are having less and less and less volume. Hence, the price will be in a range. And you will notice like the highs and the lows are flat. Okay, the price action will be flat. If you transition to the uptrend, the volume spread analysis here will show increasing volume. When you come to the distribution phase, you will notice that the volume again will shrink, it will reduce, creating a price action that is flat and in a range. Okay, but when again we will start experiencing this breakout, there will be more traders who will be joining the bearish move, hence more volume. Okay, and the downtrend, you will experience increasing volume. Okay, so volume will help you identify when the price is transitioning between the accumulation phase to the markup phase, up to the distribution phase, and consequently the downtrend. Okay, so to identify a valid breakout, you will notice that the volume here will increase during the breakout. The other part of the Wyckoff concept is that we experience a lot of false breakouts. The false breakouts here, they are described as spring. Okay, they are described as spring. This is the false breakout. How do you identify? You will identify it here. The price, yes, is breaking out, but if you look at the volume, it is either decreasing or not changing at all while this breakout is happening. When you see that in your charts, just notice that that could be a spring, a false breakout. Okay, so we've just looked at the 4 parts of the Wyckoff trading strategy, and that was, first we looked at the 3 laws. The first law was the law of supply and demand. The second law was the law of cause and effect. The third law was the law of effort versus results. We looked at the interesting composite man, the manipulator in the markets. We explained why some traders will say and experience stop hands. All right? We looked at the 4 cycles of price, the accumulation, markup, distribution, and the downtrend or the markdown phase. We have certainly looked at the Wyckoff volume spread analysis, and that will help you to identify the springs in the market and hence avoid false breakouts. Any question? We have come to the end of our class today discussing the Wyckoff price strategies, and I'm going to upload this to our social media platform. Please consider to like this video, share it with your fellow traders, and if you have gained value from this class, consider to subscribe so that you can benefit as we learn.